The MACD is one of the most effective momentum indicator that is simple to use. And this is a popular indicator broadly used across Forex, cryptos and stock market. The moving average convergence-divergence indicator uses moving averages as its input. The MACD converts to trend-following indicator and moving average into a momentum oscillator by subtracting the longer moving average from the shorter moving average. The MACD indicator is easy to use, but it is important to understand its entire structure. By understanding MACD completely, we can generate huge profit, as we can anticipate and trade larger moves in the market before it occurs. The MACD uses exponential averages as they respond more quickly to the changes in price. More weight is placed on the most recent prices, as compared to the earlier prices. While calculating the various exponential moving averages, we can use any period of length as we wish. Usually 12, 26 and 9 period moving averages are used. Let's dive deep into this MACD indicator. First we have to understand its structure, before trading with this indicator. Let's have a look at its structure. The MACD indicator comprises three components, namely, the signal line, the MACD line and a histogram. The MACD line is the faster one, and it reacts faster to the change in prices. The signal line is the slower one, and it gets frequently breached by the MACD line. The MACD histogram will represent the difference between the MACD line and the signal line. When the gap between the MACD line and the signal line is big, the MACD histogram will display higher bars. The upper part of this chart contains two exponential moving averages of 12 and 26 periods. When the two exponential moving averages come together, they are said to be converging, and when they move away from each other, they are said to be diverging. The MACD will always show the relationship between the two moving averages. Now let's see on how this MACD indicator works. Have a look at this chart. Here the top part of the chart contains a 12-period and a 26-period exponential moving averages. The bottom part contains the MACD line, signal line, and the histogram with the zero level incorporated into it. Meanwhile, you have to understand three key elements of MACD. First, when the two exponential moving averages move from each other, the MACD rises or falls. Second, when the two exponential moving averages cross, there is a corresponding crossing of the zero level by the MACD line. Third, when the signal line and the MACD line crosses, there is a corresponding crossing of the zero line by the MACD histogram. So we should pay close attention to the interaction between the MACD line and the signal line, as well as their positions with respect to the zero line. When the MACD line is above the zero line, and the shorter period moving average is above the longer period moving average, it indicates that the market is an uptrend. When the MACD line is below the zero line, and the shorter period moving average is below the longer period moving average, it indicates that the market is in downtrend. When the fast line is above the slow line, the MACD histogram is positive and above the zero level, which in turn represents a bullish bias. When the fast line is below the slow line, the MACD histogram is negative and below the zero level, which in turn represents a bearish bias. Usually MACD indicator is used in one of the following three ways: crossover, overbought or oversold conditions, and divergence. First, let us discuss about the crossover strategy. In the crossover, a sell signal is generated when the MACD line crosses below the signal line. Similarly, a buy signal is generated when the MACD line crosses above the signal line. The location of these crossovers, in relation to the zero level, plays an important role in determining buy and sell points. Bullish signals get strengthened when the crossing of the MACD line over the signal line takes place below zero level. Bearish signals get strengthened when the crossing of the MACD line below the signal line takes place above the zero level. Even though MACD crossovers works best in strong trending markets. It provides buy and sell signals very late, just like moving averages. While you may enter a trade after the beginning of a trend, and exit before the trend comes to an end, it is highly recommended to use this indicator as a buffer to reduce risk, rather than using it as the main signal. Now let's move to the next use of the MACD indicator, as overbought or oversold conditions. It is important to identify overbought or oversold positions, as it helps traders to identify when to enter and exit a trade, and to anticipate when the trend of the current market state is likely to reverse. This enables us to take more informed trading decisions. An overbought condition exists when the price performs a significant up move. An oversold condition will exist when the price performs a significant down move. When you see the MACD line rises significantly, the security or index may be an overbought condition. While using this overbought or oversold MACD technique, the strong but signal is generated when the MACD line and the signal line are below the zero line, indicating oversold condition. Strong sell signals are generated when the lines are above the zero level, indicating overbought condition. But in this technique, the risk involved is, there is no predetermined overbought or oversold conditions like RSI indicator. You have to study the behavior of MACD over time, so that you can determine these levels, when the price is in overbought or oversold position. The most popular use of MACD is MACD divergence. A divergence occurs when the trend of the price does not agree with that of the indicator. In simple words, an indicator trends in one direction, while the price goes in another direction. MACD divergence tends to indicate a reversal in the current state of the market. Bullish divergence occurs when the price is making lower swing lows, while the indicator is making higher lows. This indicates that the selling momentum is slowing, and the downtrend is more susceptible for a reversal. To make use of MACD divergence effectively, we can go for double divergence. What is double divergence? When the MACD line, signal line and the histogram of the MACD moves in one direction, and the price moves in another direction, it forms double divergence. The MACD double divergence is one of the most effective and powerful trading technique. MACD double divergence, if done correctly, will do wonders in your trading journey. I hope you have learned something new in this episode. Please do support to our channel by subscribing and leaving a like. See you in the next episode. Until bye for now.